The original Sullivan Principle, which promoted corporate and social responsibility, was developed causing South Africa to oppose their apartheid system. These principles were widely adopted in the United States.
Several publications were written to promote better business practices working towards today's standards.
The Institute of Chartered Accountants in England and Wales, in an effort to fulfill the needs of the 21st century capital markets, advocated for new standards of reporting financial and non-financial information. The United Nations Environment Program partnered with other individuals to eventually begin the creation of what is known as GRI. The GRI then became the Sustainability Reporting Framework, which incorporated social, economic, and governance issues. In 2000, they released the first sustainability reporting guidelines, and in 2002, the second version was released at the World Summit for Sustainable Development in Johannesburg. The GRI then relocated to Amsterdam and incorporated as an independent, not-for-profit organization in the Netherlands.
PricewaterhouseCoopers introduced its corporate reporting framework. Several meetings were conducted to examine the enormous challenges businesses face to prepare, combine, and report on operating and financial information with the corporation's sustainability information. In addition, discussion papers were issued by the IASB on the framework.
In response to the GRI exposure draft of the G3 guidelines, Robert Eccles and Michael Krzus issued a hypothetical integration of the Global Reporting Initiative G3 guidelines and the Enhanced Business Reporting Consortium framework on behalf of the IIRC. The GRI published Sustainability Reporting Guidelines version 3.0, more commonly known as GRI G3 guidelines.
The Prince of Wales Accounting for Sustainability Project published the Connected Reporting Framework. This document recognized 10 elements necessary for embedding sustainability into an organization.
The Prince's A4S project and the GRI hosted a meeting at Clarence House, reaching an agreement to ask the G20 to call for the creation of an international body tasked with the development of an integrated sustainability and financial reporting framework in response to the global environment crisis.
A4S hosted an invitation-only roundtable. This meeting accomplished goals of creating a work group to share research findings and recommendations using their interest and expertise in the development of integrated reporting. They developed different ideas of governance for creating an international integrated reporting committee. They also created international support to set on the June 2010 G20 agenda discussion of integrated reporting for a sustainable economy.
A social movement website was launched by Robert Eccles, Michael Krzus, and Kyle Armbruster.
Also in 2010, the Johannesburg Stock Exchange takes the first major step and makes integrated reporting mandatory.
In August of 2010, the official formation of the International Integrated Reporting Committee is announced by A4S and the GRI.
At this point, you might be asking yourself what integrated reporting is.
Integrated report is where a company takes its required financial report and its voluntary corporate social responsibility or sustainability report, and it combines it into a single integrated report.
An integrated report is not just about stapling together a financial statement and an environmental report. It's about truly integrating and explaining how those two relate to each other.
The preliminary framework includes 4 main areas. Market overview, strategy and structure, managing for value, and performance.
During our interview with Professor Eccles, he stated there are enormous challenges. One of the biggest challenges is coming up with a set of standards. Accounting standards aren't perfect, and every country has its own. And we finally got to IFRS, and now there's this whole convergence project going on. So we're trying to play that same game out now in the world of non-financial information as it was played out with financial information.
What does all this mean to users of financial and non-financial information?
Companies truly are taking sustainability seriously. They are thinking about how their sustainable strategy is having a positive effect upon a sustainable society, which will enable them to be sustainable as an organization as well over the long term. Then they need to provide a much more integrated presentation of their results.
Better clarity about the relationship between financial and non-financial performance. That in turn provides better information for decision making. That will drive better engagement with stakeholders, and all of that together lowers a company's reputational risk.
So where is your company? What risks is your company willing to take?
Is your company at the beginning of the journey filtering through the waste?
Or is your company already on the journey to clearer waters?
Thank you, Professor Robert Eccles and Michael Krzus, for your knowledge and contribution in our project. We appreciate your valued time and efforts.